Hey everyone, welcome back to Alpha Insights. I'm Brittany. And hey, if you have questions while you're listening, drop them at stockalpha.ai.
And I'm Mike. We've got a compact but important story today on cannabis. Why the biggest trade may not be the names you see on NASDAQ, but a rotation that's only just getting started.
Yeah, this one feels like a classic market structure move. So let's unpack what actually changed and why it matters.
Right. Late in April, the Justice Department and the Drug Enforcement Administration reclassified two narrow slices of marijuana from the strictest federal category to a less strict one, basically a medical carve-out. That took effect at the end of April.
To be clear, and this is crucial, the change covers FDA-approved drug products containing marijuana, and marijuana that is sold under a state medical marijuana license. Adult-use cannabis is still in the stricter federal category, and hemp-derived THC wasn't touched.
And the practical fallout here is two things. Number one, the federal tax rule known as Section 280E no longer applies to those state-licensed medical operations. And number two, state medical businesses now have a pathway to get a federal registration from the DEA if they file by the June 22nd deadline to preserve operating status during review.
So, the real question here is what smart operators can do with that pathway. The easy play, and this is the thesis everyone should be thinking about, is carve out the medical business, register it federally, and then list that subsidiary on a major exchange.
Exactly. And three U.S. multi-state operators stand out in the conversation: Trulieve, Green Thumb, and Curaleaf. Each has a different profile that makes a medical-focused carve-out plausible and potentially attractive to institutional investors who could not own OTC paper.
Trulieve is the simplest example. Most of its revenue comes from Florida, which is medical only, so carving that business out is more like relabeling than a big restructuring.
Green Thumb brings the balance sheet credibility. Analysts know it has been consistently profitable and it has a history of decent cash generation. Operationally, the carve-out is trickier because medical and adult use revenues mix in some markets. But the financials can be cleaned up to the point where a listing committee would look closely.
And Curaleaf is the wild card. Combining a U.S. medical listing with its existing European medical business could create a global medical cannabis platform that would be hard for peers to replicate quickly.
Which connects to the tax angle. Removing Section 280E for those medical entities is a mechanical boost to margins because the companies can finally deduct ordinary business expenses against taxable income in that subsidiary. That alone matters, but it isn't the whole story.
Nope. The bigger and more structural dynamic is the capital rotation. For years, generalist investors who wanted cannabis exposure parked money in NASDAQ-listed Canadian producers like Tilray, Organigram, and SNDL simply because they could. It's not a ringing endorsement of fundamentals.
Yeah, that Canadian cohort has had a rough run. To put it in perspective, Tilray is down about 96% over the last 5 years, and its share count has increased by nearly 500% since its U.S. debut. Revenue growth is modest, roughly 3% year over year for the most recent quarter, and cash burn continues.
Oof. So when a U.S.-listed, federally registered medical operator hits the exchange, the institutional logic changes. The money that's been stuck in those Canadian names for structural reasons can rotate back home to U.S. operators with cleaner unit economics and a now favorable tax structure.
Right. Data suggests this rotation is one-directional. Once U.S. medical subs are listed on NYSE or NASDAQ, a big chunk of the marginal dollar of new allocations will go to those newly listed operators, and a meaningful portion of the existing allocations should follow within 2 to 4 quarters.
That's the second leg of the bull case for the U.S. multi-state operators. And honestly, it might be the larger one. The tax benefit is finite and mechanical. The capital rotation is structural and recurring.
But here's the wrinkle. The three big U.S. operators aren't acting like companies that expect to be on a major exchange soon. Investor relations has been pretty passive. Quarterly releases, the occasional conference, not the kind of proactive narrative building that pulls new investors in ahead of a listing.
Exactly. If you wait until the morning of the uplisting to start telling the story, you mostly capture passive ETF and index flows. The investors who make the biggest dent, retail who never owned cannabis before, advisors, family offices, generalist funds, need to be educated months in advance.
And that education isn't cheap or subtle. It takes sustained outreach across the channels where these groups actually consume information. Social, podcasts, yeah, but also advisor roadshows, audited financials cleanly separated for the medical business, clear tax disclosure. Start now, not after the listing.
So, for listeners wondering what to watch over the next few months, a couple things. 1. Did the big multi-state operators file the DEA registrations by that mid-June deadline? 2. Do they begin structural carve-outs and publish audited, standalone medical financials? And 3. Are they ramping proactive investor outreach?
Also keep an eye on the administrative hearings scheduled for late June through mid-July. That's the broader rescheduling process. If that goes farther, adult use could be back on the table, and the optionality on those orphaned adult use businesses increases. But remember, adult use is still in the strict federal category today.
So to summarize, it's not just about headlines for the NASDAQ names going up. The real trade over the next year may be the rotation from the Canadian-listed producers to U.S. multi-state operators that manage to list medical subsidiaries on major exchanges, and who tell the story early enough to attract new institutional capital.
Yet analysts note that the asymmetry sits with the U.S. operators ahead of uplistings, not the Canadian producers that already had their big headline moves. The capital trapped in those NASDAQ names is the accelerant for the next leg up for U.S. MSOs, if the listings and outreach happen.
All right, short reactions. Interesting.
Right.
Okay, let's wrap with our key takeaways together.
Number 1, the federal carve-out for state medical marijuana and FDA-approved cannabis drugs changes tax and listing dynamics for medical businesses.
Number 2, a carve-out plus an uplist is a mechanical path to institutional ownership. And the smart play is to get the narrative out months ahead.
Number 3, capital trapped in Canadian NASDAQ names is likely to rotate to U.S.-listed medical subsidiaries once those listings exist. And that rotation could be the dominant market move in the next year.
Good recap. And a quick reminder, we can't give personalized investment advice. We're laying out the structural logic and what market participants are watching.
Exactly. Got questions? We'd love to hear from you. Head over to stockalpha.ai, where you can ask us anything and we'll answer live. And while you're there, check out more market content.
Thanks for listening to Alpha Insights. I'm Brittany.
And I'm Mike. See you next time.